Let's look at the income statement. These are the key features of the income statement. At the very top, we have the revenue, followed by the cost of goods sold. Then we have the gross profit, operating and non-operating expenses. Finally, at the very bottom, we have the net income. So the revenue is the total amount of sales. The cost of goods sold is the cost of the inventory the company sold. Gross profit is just the difference between the two. And then the net income is what you're left with at the end after you subtract all the expenses. Simply put, net income less than zero means the company is not profitable. And on the other end, if net income is greater than zero, then that means the company is profitable. These are the main formulas worth knowing for the income statement. Let's look at the 10Q filings for the fourth quarter of 2024 for e.l.f. Beauty. We can see that the net sales is on the first line. This is the same as the company's revenues. On the second line, we have the cost of sales, which is the same as the cost of goods sold. Then we have the gross profit, which is basically the net sales minus the cost of sales. After that, we have the operating income, which is what we get after we take out all the operating expenses. Finally, at the bottom, we have the net income, which is what we get after we take out all the non-operating expenses, which includes the interest and taxes, and we take that from the operating income. Taking a quick glance at the income statement, we can see that the net income of Q4 2024 is actually lower than the net income of Q4 2023. So usually what you want to see is actually an increase of net income from one year to the other. But in this case, we see a decrease. What else we can notice is over here, one thing to calculate is actually the gross profit margin. So how you do that is you do gross profit divided by net sales. So in this case, for 2023, we have this number 191,957 divided by the 270,943, and we get about 71%. If we do that for the next year, we also get about 71%. So that's not bad, especially in this type of industry. Having 71% gross margin is actually very good. Another key feature we can look at is the net profit margin, which is what you get when we divide this number, the 26,888, which is actually 26 million, because all these numbers are in thousands, but for calculation's sake, it's fine. We can do this number divided by this number, and we get about 9.9%. Then we compare it to this number divided by this number, and we get about 4.9%. So what you can actually see is that's not very good because the net profit margin is decreasing, and what you usually want to see is actually an increase because of economies of scale of the net income margin. There are many other formulas that you can look at to further analyze the income statement, but hopefully the ones I've given you will help you get a better understanding of this financial statement.